In 2023, commodities have been doing well and are considered a positive aspect. Gold and silver prices have reached their highest levels in several years, and the demand for metals used in electric devices and batteries is also increasing. As a result, many investors are interested in investing more money in commodities. Gold has surpassed the $2,000 mark, and there is significant support from central banks and Wall Street. Some exchange-traded funds ETFs have also shown interest in investing in gold. The question is whether this trend of investing in gold will continue in the future. Welcome to today's video. We will be looking at what the factors that will cause gold price to keep rising. I believe that in the short to medium term, the current high gold price of $2,000 can be sustained. However, it's important to note that this record price is measured in nominal terms and not adjusted for the inflation or the declining value of the dollar. It's important to understand a few other things. Throughout history, what has primarily affected the price of gold is people's concern about preserving the value of their money when using traditional savings methods. And there is nothing that should worry savers more than low interest rates that don't keep up with inflation. Let me give you an example. The US 10-year Treasury bond pays an interest rate of 3.4% per year for 10 years. But the US Congressional Budget Office says that the value of the US dollar is decreasing by 7% each year. So, essentially, the US government guarantees to reduce your purchasing power by 3.5% every year, compounded over 10 years. To put it simply, the first promise made by the government that I believe they will fulfill in my lifetime is that they will erode the value of your money. This is why gold has been performing well this year. It provides a way to protect your money without taking on additional risks. It's also important to consider how high the price of gold can rise. In the United States, the market share of precious metals and related securities is less than half of 1%. This means that investments in precious metals make up less than half of 1% of all savings and investment types in the country. The average market share over the past 40 years has been 2%. I believe that factors such as negative real interest rates, quantitative easing, high debt, and deficits will push the market share of gold back to its four-decade average. If that happens, the demand for precious metals and related assets will increase fourfold, which is exactly what I expect to occur. Surprisingly, junior gold equities, smaller companies in the gold industry, are currently valued lower than what historical measures would suggest. At this stage in the cycle, juniors should be performing better. There are three factors that may be holding juniors back. First, gold bull markets are typically led by larger companies, and we have seen that happening this time as well. Generalist investors who are entering the gold market tend to focus on larger cap companies, causing smaller cap companies to lag behind. Second, the merger and acquisition cycle, which usually benefits juniors, is just beginning. Lastly, it's important to note that this gold bull market is different from some previous ones in terms of the challenges it faces. The current situation is that the equities market, particularly small cap equities, is experiencing a delay in its performance. As a result, marginal equities, including non-revenue producing gold junior companies, have been disproportionately affected. It's important for investors to be more selective when considering junior companies. There are approximately 2,000 mining junior companies worldwide, but only around 300 of them are likely to be viable. However, if the price of gold continues to rise and larger companies perform well, the junior companies will also benefit. This pattern has occurred 4 times in the past and follows a predictable trend. While the exact timing is uncertain, I believe the outcome is inevitable, even if it's not immediate. Although we can't determine exactly when the catalyst will occur, there are 2 potential catalysts for the juniors. The first is mergers and acquisitions M&A activity. Recent examples, such as the takeover of Sabina by B2, have been positive for the acquiring company and the shareholders of the acquired company. M&A activity brings liquidity and optimism to the sector, with everyone looking for the next opportunity. The second catalyst is the exploration efforts that junior companies have been able to undertake with the funds raised in the past 10 years. These exploration efforts are starting to yield results. Typically, when money is invested in exploration, we expect to see exploration results within a few months, the process of exploration and making significant discoveries in the mining industry works differently. It typically takes around 10 years of focused exploration in new areas to start seeing positive results. Currently, we are witnessing the early stages of a cycle of discoveries. Some notable recent discoveries include those in Burkina Faso in West Africa, the predictive discoveries, the Chalice discovery in Australia, and the exciting new discovery by Canadian-listed Reunion Gold in Guyana. These discoveries indicate a renaissance in terms of successful findings, rather than just increased spending on exploration. Based on this, my belief is that the ongoing success in making new discoveries, combined with mergers and acquisitions M&A activities, will be the driving force behind the growth of the junior mining sector.